Everybody. Thanks for joining us today. We are delighted to be joined by Philip Petursson, Chief Investment Strategist for IG Wealth Management. And we are always looking forward to conversations with Philip just because he is so skilled at distilling down some of the common themes and observations regarding market and economic conditions. And many of our clients are familiar with Philip through the weekly podcast, The Living Market, or his appearances on multiple mainstream and financial media outlets. So, Philip, we're delighted to have you. Thanks for joining us.
Dwayne, thank you for having me. It's a great pleasure to be here today.
As I mentioned, it's oftentimes overwhelming, just the sheer volume of data and opinions regarding economic and market conditions. And to be frank, there's not a lot of convergence or consensus on those opinions. So that's why we so much appreciate your kind of simplification of those issues. So right off the top, I'm wondering if you can just share with us a distillation of your observations regarding current conditions.
Yeah, certainly. I think when we look at the environment, we've gone through a bit of an economic slowdown, but it's more in line with what we would call a mid-cycle slowdown, as opposed to a recession that people were predicting, a year ago or at the start of this year. A lot of the recessionary conditions or the pressures that we saw at the start of 2023, particularly in the United States, are behind us. Now, that's not to say that things aren't slowing down a little bit as we go forward. We do see Canada in a weaker environment for 2024. But again, is it going to look like perhaps the last thing that we went through in 2008? And we would say no. And the key difference here is that the labor market is remaining quite tight, which means unemployment is likely to remain lower than what we would see in a typical recession. And that's going to keep the weakness, I would say, more moderated. We've called it a soft landing, myself and in the press, meaning, yes, we see a slowdown of activity, but it doesn't come with the high unemployment that we would typically see in prior economic cycles. So the environment, yeah, and again, let's go through the last couple of years. Is it anything surprising to see that the environment slows down a little bit after the very, very strong 2021 and 2022 that we had? No, I mean, the economy ebbs and flows, and that's what we're seeing right now. From the market perspective as well, yeah, last year was a challenging year for investors, both with fixed income and bonds. This year's been better. The bond market hasn't been fantastic, but it's been positive, and the equity markets have been positive as well. Volatility, that's kind of the norm. I mean, that's just so, and the volatility that we've seen this year is right in line with what we would expect at any point in history. So, yeah, despite the headlines that we read, the environment has been, pretty much like as we would expect in any other part of the market cycle that we've been through over the last 50 years.
Yeah. That's a great observation. In fact, in many of our conversations, clients are pleasantly surprised when they see actual portfolio performance relative to what they perceive to be a doom and gloom scenario based on headlines. In light of all of that uncertainty that's going on in the world, be it geopolitical issues, high inflation, high interest rates, clients often ask us if there's something specific they should be doing, because when you're confronted with uncertainty, we tend to want to control things and feel compelled to do something, anything. And certainly status quo or do nothing seems like the last thing we should be considering. What would your response to that thinking be?
Certainly, it would be, I suppose, if we want to do anything, it's keep our emotions in check, control our emotions. We often draw a line between geopolitical events or headlines and our portfolio, and often the two are not linked. So by stepping back and checking our emotions, what we're allowing to happen is our underlying portfolio managers, and myself included, can shift the portfolio given whatever is in front of us. So that's to take advantage of some of the upside or position against some of the risks that we see coming forward. So often, like, while we might not see it on a day-to-day basis, there's activity within the portfolios on an ongoing basis. And to make a knee-jerk reaction to a headline is often a mistake.
Yeah, well, so you partly answered this question, but maybe you can just expand on it a little bit. Um, as I said, despite these gloom and doom headlines from time to time, there are opportunities for savvy investors to take advantage of the current environment. So I'm wondering what strategies you and your team are taking advantage of in the current economic environment.
Sure. And there's a couple things that we're doing. And I would say, despite everything that's going on, I'm going to give you a little bit of a lead in into our thinking for 2024. And we're ending off our 2024 outlook with this question: what if it goes right? Everyone is so focused on the negatives out there, and it's really hard to actually support those negatives with any economic or market data, right? A lot of that is behind us. So we're asking the question, well, what if it goes right? And what that looks like is, yes, you know, we do see the global economy in large part actually showing some improvement through 2024. We see corporate earnings actually increasing through 2024 at a time when valuation is very attractive. So some of the things that we're looking at um, is bringing everything back to balance. Now, it might seem, you know, almost like, you know, are we hiding behind our asset allocation because we're not sure of the environment? No, actually, we're actually should say much more confident in the environment for next year, that bond returns are going to be much improved. And a lot of the measures that we look at that look at the potential for bonds relative to equities are saying that bonds are actually a very attractive place to be over the course of the next 12 months. So we like our allocation to bonds. And then from the equity perspective, we don't see the potential for big deviations across asset classes. Meaning, you know, we think that Canadian equities, US equities, and international equities are probably going to move in the same direction with the same magnitude. And so we're bringing things closer in balance. The opportunity is be invested. And that's where I think some of the risk lies, that we've seen cash positions over the last 2 years increase substantially. I think they've more than doubled from where we were at the beginning of say, or in 2021. And that's because investors were perhaps nervous of what happened to COVID, not really ready to put assets back to work. But we saw cash positions at a massive amount, and that could underperform what we expect in the bonds and equity markets for next year. So the opportunity is be invested, to be honest with you.
Yeah, again, I think you've largely addressed my next question, which was related to fixed income specifically, because as you've observed, cash positions are relatively high in a lot of portfolios. And that sentiment of kind of risk aversion is certainly understandable when things are uncertain. But can you speak to the risk that high cash positions or GICs can present to a client portfolio?
Right, certainly. Everything comes down from an asset allocation perspective in terms of, and you know this, it's all about the plan. And the plan can be short-term goals, medium-term goals, and long-term goals. Short-term goals could be within a year. And I always say, look, if you have a financial goal within the next year that needs to be realized, cash is the best place for that, right? But if I'm looking towards my retirement, that's a longer term goal. Even if I'm approaching retirement within the next 5 years, my retirement plan is 30 to 40 years long. So in that regard, cash historically is the worst place to be. It underperforms other asset classes. Now, when we look at cash relative to bonds, or we can look at GICs relative to bonds today, at the surface, the return potential or the yield, let's put it as interest rate equivalent, it's roughly the same. You can pick up a GIC for 5% ish, and bond yields are let's call it 5.5% in one of the portfolios that I manage. So on the surface, it looks the same, saying, well, but I know cash is going to give me 5, or GIC is going to give me 5. I can lock that in. True. You lock it in and you lock out any upside potential. So we do sensitivity analyses on the potential for bond returns going forward. And what we see is we're likely at the end of the interest rate cycle. Bank of Canada is not going to be raising rates. In fact, they're starting to allude to the fact that they can cut rates in 2024, and we're of that mind as well. Inflation's not a problem anymore. It's going to settle in at around 3% and gradually come lower. So what does that mean for interest rates? Interest rates are probably going down, not up. In bond, from a bond world perspective, that's good. That's good for performance. As interest rates fall, the price of the bond goes up. Now we're starting at the mid 5% expected return just on the yield alone. And the upside is, well, what if the Bank of Canada cuts? What if the Federal Reserve cuts interest rates next year? What if interest rates start to come down because inflation is lower? That's much better for bonds, whereas the GIC has a guaranteed rate and you're guaranteed never to make any more than that.
Yeah. Terrific insights. Thank you very much, Philip. I appreciate your time. Again, for those who are interested in hearing on a more regular basis from Philip and his team, please remember to subscribe to the Living Market podcast. And for those of you who have online access, many of his quarterly reports and ongoing market commentaries are available there as well. So again, Philip, we thank you, appreciate your insights, and have a great day.
Thank you, and you as well.